Bitcoin is once again at a critical turning point. After months of sustained pressure, the world's largest cryptocurrency has fallen below the $70,000 level, effectively erasing all gains made since its November 2021 all-time high near $69,000. This move marks a major shift in market structure and sentiment. In this report, we break down why Bitcoin has fallen so sharply, what on-chain data is revealing about investor behavior, how derivatives markets intensified the sell-off, why institutional support is fading, and whether this move represents a temporary correction or the early stages of a broader bear market reset. This analysis is based on verified data from Glassnode, CoinGlass, ETF flow trackers, and market analysts, not speculation or hype. Bitcoin falls below $70,000. Bitcoin dropped as low as $69,040 on some exchanges on Thursday, marking its lowest level since October 2024, according to price data from the block. At the time of reporting, Bitcoin was down more than 8% on the day, roughly 30% lower year over year, and nearly 45% below its October peak. The $70,000 level was both a psychological and structural support zone. Its failure suggests that selling pressure has overwhelmed buyer demand, at least in the short term. This was not a sudden reaction to a single headline. It was the result of gradual weakness building across multiple market layers. On-chain data shows a defensive market. According to Glassnode, Bitcoin has entered what analysts describe as a decisively defensive phase. Several on-chain signals confirm this shift. Realized losses are accelerating. Spot market demand remains structurally weak and forced selling is increasing across both spot and derivatives markets. In simple terms, investors are increasingly selling at a loss, which typically occurs during fear-driven phases of the market cycle. Glassnode analysts Chris Beamish and Antoine Colpert noted, spot Bitcoin volumes remain structurally weak, reflecting a demand vacuum where sell-side pressure isn't being met by sustained absorption. This lack of buyers has made the market vulnerable to sharp downside moves. Breakdown below. The true market mean. Bitcoin has now fallen below its true market mean, a key on-chain metric. This indicator tracks the average acquisition price of actively circulating Bitcoin supply and has historically acted as a dividing line between bullish and bearish market regimes. Trading above the true market mean generally signals healthy market conditions. Trading below it often coincides with early bear market transitions. Glassnode analysts say the loss of this level confirms a broader structural breakdown that has been forming since late 2025. This move aligns Bitcoin's current behavior with the early stages of previous bear market cycles, rather than a simple short-term correction. Accumulation zones emerging. Despite the negative signals, on-chain data does show early signs of selective accumulation. Glassnode data indicates growing accumulation between $70,000 and $80,000. A dense cost basis cluster between $66,900 and $70,600. This range could act as a near-term shock absorber, slowing further downside if selling pressure eases. However, analysts warn that realized losses currently average over $1.2 billion per day. Fear-driven selling remains active. In other words, accumulation is forming, but panic selling has not yet fully subsided. Derivatives markets amplify the move. The sell-off was significantly amplified by the derivatives market. As Bitcoin slipped into the low $70,000 range, futures markets experienced the largest long liquidation spike of the entire drawdown leverage had rebuilt rapidly, despite weak spot demand. When price began to fall, these leveraged long positions were force closed, triggering a cascade of liquidations. According to CoinGlass, more than $1 billion in crypto liquidations occurred in the past 24 hours. The majority came from long positions. Because exchanges release liquidation data in stages, analysts believe the true figure is likely much higher. Options. Market signals. Further risk. Bitcoin options markets are also flashing warning signs. Traders are pricing in elevated downside risk. Short-dated implied volatility has risen sharply. Downside skew has steepened. Investors are paying a premium for downside protection. This behavior suggests market participants are hedging against further losses rather than positioning for a strong recovery. Institutional demand continues to fade institutional demand once a stabilizing force has weakened significantly. Net flows across spot Bitcoin, ETFs, corporate treasury holdings, government-linked Bitcoin exposure have all turned negative. U.S. spot Bitcoin ETFs recorded a second consecutive day of outflows, totaling $545 million in a single session. The loss of ETF inflows removes a critical source of demand that previously helped absorb sell-side pressure. Corporate treasuries under pressure. Several high-profile Bitcoin treasury strategies are now under stress. Strategy, led by Michael Saylor, holds over 713,000 BTC at an average acquisition price of just above $76,000. With Bitcoin trading below that level, the position is now underwater. ETF investors are also facing growing paper losses, as their aggregate cost basis remains well above current prices. Historically, when large institutions sit at a loss, new capital deployment slows, adding further pressure to the market. Macro deleveraging drives the move. Market analysts stress that Bitcoin's decline is part of a broader macro trend. Kyle Rauda, senior market analyst at Capital.com, explains, Bitcoin's slide reflects broader deleveraging across risk assets as volatility spreads through equities, commodities, and crypto simultaneously. This suggests the move is being driven less by crypto-specific narratives and more by balance sheet mechanics and liquidity tightening. Bitcoin is not trading in isolation. From distribution to reset. Some analysts believe the market is entering a prolonged reset phase. Nick Puckrin, co-founder of Coin Bureau, describes the transition as a shift from distribution to reset. Historically, these phases last months, not weeks, are marked by volatility, weak rallies, and slow rebuilding of confidence. Glassnode echoes this view, stating that without a sustained return of spot demand, any relief rallies are likely to be corrective rather than trend reversing. Bitcoin is now navigating one of the most challenging phases of its current cycle. Bears control the short-term trend. Market structure has weakened. Institutional support has softened. At the same time, accumulation zones are forming. Long-term positioning is quietly developing. The key variable remains spot demand. A durable recovery will require time, absorption, and renewed conviction from buyers. Until then, volatility is likely to remain elevated.